Drivers for small cap, I think, continue to be a steady, slow growth economic environment, and then it becomes much more company specific in terms of innovation or other competitive opportunities. In terms of the difference between small cap and large caps as measured by the Russell 2000 compared to the S&P 500, what we observe is about a third of the difference year to date is explained by some very large tech companies that probably correctly so have been anointed as the winners in their particular areas, such as Amazon and Netflix and Facebook. The rest to me is really more of timing issues and catching up as large caps had lagged, small caps for a while and now outperforming. We don't see any fundamental reason on the difference year to date or going forward. Tax reform is important, potentially disproportionately important to small cap companies, given that as a group they tend to be more US based in terms of their business. In terms of infrastructure spending, I think that would be much more broadly spread throughout the market cap ranges as different companies have different exposures, and that would be more of a sector and company specific type of question in our opinion. The two areas that we see a lot of controversy today, one has been energy and continues to be energy, given what's happened with the continued growth in supply of oil and therefore prices of oil. The second area has been on the consumer discretionary side, specifically on retail. A lot of question marks about retailers. Performance has not been very good. Consumers have been under pressure given the rising spending for healthcare and rents and other parts of the consumer balance sheet that's been stretched. On the competitive landscape, Amazon and other online providers have continuously taken market share, and so that's the pressure for a lot of retailers. They're having to replicate costs to compete online while still having a bricks and mortar presence, so increasing costs with, at this point, not necessarily very good returns to show. On the positive side, year to date and second quarter to date, it's been, I would describe, it's been idiosyncratic one-offs. It's been one healthcare company that was acquired, Acorn. We've had a couple of technology names that are completely unrelated to each other that have contributed nicely. And also we've had good contribution from consumer discretionary. So it's been broad-based in terms of industries, and there's really no particular common thread among the stocks that have helped us so far in this period. The two areas that have hurt us the most so far year to date have been materials and energy. On the materials side, it's been mostly us being underweight materials while the group continues to have good performance. We've reduced and exited some of positions and has resulted in our underperformance by being underweight that group. The second one has been energy, and as I said, we've underperformed even the group, and that's been stock picking, just a stock selection in those particular names. We've gone back, reassessed. In some cases, we've actually added to our positions. So we think they're in good position from a standpoint of balance sheet, so ability to continue to invest and be in good position throughout the cycle. We continue to believe that's intact, and the opportunity is not being discounted in specific stocks. My outlook is mostly unchanged. Continue to see a steady, relatively low growth environment for most companies. On the cost side, we haven't seen major changes that would be concerning from a margin standpoint, but one area that we continue to pay close attention to and trying to understand what may be happening is labor costs. Ultimately for us is finding areas where there is some sort of dislocation, where price becomes dislocated from our opinion of value under a wide range of scenarios.